And welcome back to the newest installment of the Bull Time Investor, where we cut through the chaos and help you make smarter moves in the market. I'm Corey Marlowe, and joined as always by my wonderful co-hosts, Scott Hartman and Adam Johnston. Hello, fellas.
What's up, Corey?
Boys, how you doing?
All good, all good. So let's talk about Q1. It's in the books, obviously. And what a quarter it was. Sweep, volatility, tariffs, obviously, it's just a crazy start to the year. I mean, that's all I can basically say about that.
Absolutely, Corey.
A bit of a roller coaster.
Yeah, big roller coaster. Investor optimism started pretty strong in January. We had some rate cut hopes, which still haven't happened. Some economic growth, you name it. Change that all kind of changed pretty quickly once trade tensions and policy misfires started rolling in.
Yeah, and then once people got nervous that the tariff threats were real, consumer confidence sank extremely fast. And investors went from being hopeful about things to come to being spooked literally overnight.
Yeah, and I mean, obviously, most of that stuff happened, in the last couple of weeks. So let's kind of walk it back a little bit to the beginning of the year, right? So January we were set up pretty good for the year, right? I mean, we saw some pretty solid gains. As Scotty alluded to, the Fed was talking rate cuts. Markets had a pretty solid bump there with the rally post inauguration,
for sure.
And I think hopes were certainly high for a business friendly agenda with the new incoming administration.
Yep. And then kind of came the first red flag, Trump's Colombia tariff threat. It didn't really stick, but it kind of planted the seed for kind of all the stuff that we've kind of played throughout the last month or so, for sure.
Yeah, and then the tariff threats to Mexico, Canada, China, and pretty much all of our other trade partners started hitting the headlines. And investors finally started believing the threats weren't just Trump, I guess, talking, but, truly moving forward with it.
Yeah, and then ultimately, they're real quickly, right? All of that kind of culminated in March with the 25% tariffs being implemented. Obviously, consumer sentiment just got smoked. You saw the VIX, obviously pop. GDP forecasts are negative. 10-year went crazy. Markets just kind of tumbled, right? So,
and then you had companies start cutting their outlook for the year. They just didn't know what to expect. They didn't know what costs were going to be.
For sure. Yeah, and the hard data, for the quarter was S&P 500 was down 4.27%. NASDAQ was down 8.07%. The Russell 2000 was down 9.48%. So, yeah, it was a rough quarter for sure.
Yeah, international markets fared a little better, right? Foreign developed markets were up 7%. Germany and the EU signaled stimulus plans, and China showed strong economic data that helped the international markets.
Yeah. Meanwhile, in the U.S., our headlines just screamed volatility, right? And where potential global investors maybe saw some opportunity.
For sure. The big losers here were consumer discretionary and tech. Tesla, there's just a lot of volatility around Tesla for sure. Chinese AI DeepSeek kind of rattled a lot of U.S. tech's dominance narrative when it comes around the artificial intelligence stuff. That's going to take some time to kind of play out, but we'll kind of see what that looks like for sure.
Yeah, I think it'd be fair to say too. I mean, you saw a lot more movement in Mag 7 to the downside. Mag 7 really controlled market growth before, and now it kind of controlled market declines. But we had energy. Energy was up thanks to global growth hopes. Healthcare, utilities, consumer staples held steady. They did okay, right? And defensive plays winning during uncertainty, that kind of stayed the course.
Yeah, I think it's also worth noting too, just a kind of a market shift dynamically, right? I mean, value outperformed growth in Q1. So that kind of old school value tilt, finally had its day in the sun for the last few months, right?
For sure. But then gold's over $3,000 an ounce, all-time highs. And that's, normally that's kind of a investors kind of looking for safety.
Inflationary hedge
when there's chaos out there, for sure.
And bonds held pretty steady, especially long duration ones. maybe a signal that investors are bracing for slower growth and trying to pick up the longer term duration bonds before interest rate cuts get deeper than what we've already seen.
Yeah, interesting to note too. I mean, oil, dipped slightly, but then kind of rebounded late, towards the end of Q1. But then obviously April for oil has not been pretty. It's kind of been plummeting there. So, but commodities overall up nearly, I think, around 5% for Q1. Yeah, and that's a lot of that primarily is just due to inflation fears and the outlook for demand. So I guess that's just a wrap on Q1 briefly. I mean, so let's talk Q2. Obviously, things, as we mentioned the last couple of weeks, really just got kind of turned on their heads, right? But I would say, at least I'm thinking the people that we follow and read, despite kind of all the fear towards the end of Q1, I'm not necessarily certain that the economy is just completely falling apart, right? I mean,
Sure.
if you look at the macroeconomic data, there's a lot of good stuff that's still out there if you kind of want to cherry pick any sort of good news, right? I mean, unemployment's around 4%. Manufacturing is holding. Consumer spending is still crazy.
Still solid for sure.
So people are spending money. But the real question kind of was just Q1, was it sentiment shock? I mean, what do you think?
Yeah,
I think a little bit of a self-inflicted wound.
Yeah, that too, for sure. We're hoping that it's, just kind of the sentiment shock for sure. That's kind of the bet we're hoping. If policy communication kind of improves over the next couple of weeks, the tariffs kind of stabilize as far as them just kind of, doing some negotiating, that kind of stuff, getting some good news out there. We do think markets could rebound quickly with some of that good news from that for sure. But quarter one was definitely there was definitely some valuation reset on some major stocks, even bond market was a little wonky too. So yeah, for sure.
Yeah, and I think we still, outside of tariffs, right? There's a couple other things out there that I think could move the markets. There's been talk of a Trump administration being good for businesses with deregulation. The tax cuts that he put into place his first term that were set to expire, I think, with talks of those being extended, those could both be positives for the market moving forward and hopefully correcting tariffs as well.
Yeah. So I mean, quick hit, I guess, for Q1. What's your biggest takeaway, biggest surprise for Q1, Scotty? What do you think?
Yeah, I would say the massive gap is what I would call it between fear and fundamentals. Stocks dropped on what everyone thinks might be happening compared to what actually is. Which I mean, that's generally the market. I mean, it's usually a forward-looking thing, but and anytime there's uncertainty, it certainly causes volatility. But it does seem like we're, that's maybe a bit overplayed at times for sure.
Yeah. How about you, Adam?
I would say I was a little surprised by the international outperformance that we saw in the first quarter. I would say that was probably driven mostly by the tariff concerns and the talk. When before the 90-day pause happened, there was talks of kind of EU and some other trading partners working on deals with China, and I think that really kind of helped drive that international market. So that caught me off guard a little bit.
What about, as far as investors, what do you think takeaway for investors?
Yeah, I mean, I think it's the stuff that we talk about every day, but diversify, stay invested, turn off the TV, don't let the noise kind of knock you off course, have a plan, stick to the plan.
Yeah, I think stick to the plan is key. You can't react emotionally as hard as it is. When you look at the markets moving, you see big movements down with the Dow or the S&P. Remember, the Dow is 30 stocks, right? One stock having a terrible day could really drive that Dow number down significantly. So if you're diversified inside of your portfolios, knowing that you're probably outperforming what the indexes are doing, just taking a breath, realizing everything's on sale right now. So if there's any dry powder on the sidelines, as we continue these conversations with tariffs, taking advantage of of the discounted pricing on a lot of these good companies out there and just putting some of that money to work.
I mean, yeah, and right now, obviously, with everything kind of happening and the uncertainty with obviously the tariff talk and what's happening in Washington and the tax cuts and all these kind of uncontrollable black swans, right? I mean, it's getting pretty volatile,
for sure.
pretty volatile out there. So, I mean,
For sure.
how are you holding up?
Yeah, I would say volatile is putting it very mildly, Corey. Between tariffs, tech tensions, and just rate cut debates, there's just a lot. It just feels like the markets are just on a roller coaster with maybe without a seatbelt or a broken seatbelt for sure.
Yeah, and I'm just trying not to watch the dollars and cents in the accounts, if you will. It's just really looking at positions and what what opportunities can we take, and is there something that we need to remove for a reason of the company performance versus just what the markets are currently doing.
Yeah, for sure. And I think a lot of it, I mean, we talked about this briefly in the beginning of the episode. I mean, it's all really driven by the tariffs, right? I mean, just a lot of this capitulation, a lot of this uncertainty, a lot of the market volatility, not all of it, but I would say probably 90+%, is driven by kind of the tariff talk. And now you've got, the president potentially bumping heads with the Federal Reserve Chairman. That's never a really good thing. Nobody likes to see that. So
yeah.
I mean, so let's kind of touch on this 25 tariff wave. I kind of want to get down into the weeds just a little bit while
Sure.
we have a bit of time left. So, and kind of what it means for the markets and sectors and investors like our clients. I mean, there's a lot of noise out there, but let's try and make a little sense of it, right?
Yeah. So let's set the scene. April 3rd, President Trump declared what he's calling Liberation Day.
Liberation Day.
Yeah, full-scale tariff overall. We're talking 10% on all imports. Here's a kicker: 54% on Chinese goods, which I think that's higher than what that is now. I think I think it's maybe double that.
I think it's up to 245%.
Yeah, there you go. Yeah,
and going,
maybe 4 times. Yeah. 20% on EU imports and some real curveballs kind of were thrown at Vietnam, Japan, among some other countries for sure.
Yeah, and once the Liberation Day hit, and the massive tariffs that some of these countries saw, the markets didn't wait to digest anything. The S&P dove over 10% in 2 trading days, steepest drop since 2020's pandemic panic. Investors were reacting as if the trade war came back from the dead with a vengeance and was taking over on that day.
Well, and rightfully so, right? I mean, these aren't just minor tweaks. I mean, they're sweeping structural changes, right? I mean, you're trying to rip off a Band-Aid of 80 years of trade policy in
in a day,
a week, however long. Yeah.
Sure.
And then, I mean, obviously overnight, right? Then you got companies that just are having to reevaluate, supply chains and pricing strategies, and in some cases, whether their Q2 earnings, their guidance even holds. I mean, I know, especially in Elkhart County here, we have a lot of business owners and a lot of clients that work, in specific industries that could have, major effects as far as pricing is concerned with the tariff stuff. Yeah,
for sure. Yeah. I guess
they're going to absorb all the costs, right? They're going to have to pass them on to the consumers.
Yeah.
Somebody's got to pay for it.
Yeah. So we've got to figure out, we just want to kind of go sector by sector, kind of talk a little bit about winners and losers. Spoiler alert, the losers are kind of stacking up.
Yeah.
Yeah. I mean, really with the cyclicals, they're taking it on the chin pretty good. Energy, materials, industrials, real estate, consumer discretionary. Some analysts are slashing earnings outlooks by 65% or more in the second quarter so far.
Geesh.
Let's not talk about the ones that pulled guidance altogether.
Tech's faring a little bit better, at least relatively. I guess I'd say Nvidia is still, kind of that Wall Street darling, whatever you want to call it, for sure. But they're still facing some headwinds with costs. Of course, AI chip regulation. It's going to be, it's still a tough road for them too. And I know that the tariffs and part of the kind of working with China, that kind of thing, it appears that, some of that stuff our government's trying to kind of slow down a little bit for sure.
Yeah.
Yeah. It seems though that financials they've stayed a little insulated from some of the downturn. JP Morgan, Citi have international exposure, but aren't as directly hit by the import tariffs as say, companies that are out building, buying and selling product. So
sure.
their challenge is more about interest rate uncertainty than
Yeah.
trade disruption, I think, at this point, at least.
Yeah, I think it'd be really hard for them to do projections and forecasts right now with kind of what interest rates have done.
Yeah, that's the key, right?
For sure.
And that's kind of the elephant in the room too, especially with the most recent kind of butting of heads with the Mr. Powell and,
sure.
and President Trump. I mean, yeah, that interest rate sensitivity is going to be interesting and really going to be kind of the narrative to follow for the rest of the year outside of the tariffs.
Yep.
There's some winners though. I mean, I think, we've had a couple of MVPs. I think, consumers, right? So apparel prices are up 65%. You got leather goods up, like 90%. So we're seeing kind of a tidal shift in buying habits.
Should have bought that leather jacket last year.
Yeah.
We've seen, especially with the generation that's a little bit younger than us too, thrifting is a big deal, right? Like Poshmark, the Real, eBay is really kind of seeing a second wind with all the stuff with people just looking to save money and also not be involved with the tariff, kind of evade the tariff tax entirely for sure.
Should we thank Macklemore for that one?
Yeah, there you go.
That's right. Yeah.
Have to get him on the podcast.
Right? Love it.
So yeah, I think it's cultural, right? Gen Z, people love thrift shopping. And this trend just seems to kind of keep going up.
Yeah, just any way around the tariff tax, reality.
It feels like it's on warp speed right now for sure.
Yeah, and it's I think it's worth noting for investors too. Your resale platforms, logistics companies that are tied to returns and even kind of the vintage markets could see an upside in the climate. I mean, it's just an interesting kind of dynamic shift that we haven't seen at least in 20 some years.
A while for
sure. Let's pull back a little bit, guys. Let's look at the macro play here. Latest Reuters poll put recession odds at 45% for this year. It was as high as, it was over 60. And then with the 90-day delay, that's brought it back down. But just a month ago, it was only at 25%.
20 something. Yeah. 25. Yeah.
Yep. For sure. GDP growth forecasts are down to 1.4% for the year. While inflation isn't surging yet, the Federal Reserve is in a real bind. They can cut rates and possibly create more inflation by doing that, or they can hold and watch the economy sputter out.
Yeah, and then obviously, meanwhile, as we talked about, Trump's pushing for rate cuts, which you can probably argue both sides of that coin, but he's claiming inflation's under control. Is it? We don't quite know yet. But the Fed's models are kind of suggesting tariffs could push inflation up, right? And so, I think they said 1.5, 1.6 percentage points, something like that, and then obviously push unemployment up too, right? I mean, it's gonna have I would assume it would have an effect. I think the forecasts are 0.5% to 1% increase on that. So,
yeah, and I think a lot of volatility here recently too is is Trump going to try to fire Powell, Fed Chairman Powell?
Well, I don't think
it's supposed to remain independent, but he's not doing the markets any favors right now by flirting with the thought of that.
For sure. It's it's a tightrope, and Powell definitely doesn't have a safety net.
No, that's for sure.
Yeah. It's the Walenda brothers, right? Those guys. Yeah, they walk between buildings and all that stuff. Yeah,
you're dating yourself.
Yeah. So if you're listening to this thinking, okay, yeah, great, this is really great. Like, what do we do next? Here's kind of financial partners take. So yeah, go ahead, Adam.
Yeah, I think diversification and avoiding sector concentration is pretty important right now. Tariffs are kind of uneven. So stick with that diversification. It's your shield. I think there's a lot of really good companies that are on sale right now or even clearance. And I think if we're diversifying out to those, there's not a need to necessarily chase the next Amazon or
Yeah.
anything like that right now.
Yeah, I piggyback off of what Adam said too. I think it's kind of turned into more of a stock picker's market, right? Know what you own, why you own it, be cognizant of your portfolio. You know, you got tech and financials are kind of showing some signs of strength, right? So are kind of the US sort of centric businesses with just, you know, minimal reliance on the global supply chain, right? Just anybody it's kind of tariff, you know, non-adjacent, I guess I should say, for lack of a better term.
Yeah. Watch consumer trends. You know, if resale and secondhand markets are gaining ground like we think they are, there might be some opportunities and services that utilize that, like digital marketplaces, logistics, and even like a dual authentication tech out there.
Yeah.
Yeah, and I think the biggest thing too is we can't panic and sell and go to cash. I mean, selling into fear is rarely the right call. I mean, think about, we got the announcement that there's going to be a 90-day delay on the tariffs and a 10% flat tariff on every country besides China. I mean, we saw the markets jump 10% in one day.
But volatility is just insane.
Yeah. So selling into the fear is not the answer. Adjust as you need to, but don't miss the recovery when it hits.
Yeah. That's a good point. And so I guess let's close with a quick round here. What's I guess one thing you guys are watching, you know, maybe this week or in the next couple of weeks here in April and into May?
I'm paying a lot of attention to the Fed. You know, whether Powell, if he shifts in his tone at all, market's going to react very quickly, and that can be a positive or a negative, I guess, as far as what his tone, where it is. But clearly, if he starts talking about lowering interest rates, those kind of things, we do think the market will probably move pretty quickly to the upside. But it's just, there's a lot. He's got a tough job right now for sure.
Yeah. Adam, how about you?
No doubt. Yeah, I'm kind of watching more consumer driven. Target, Walmart, Nike, they're import heavy. They've kind of cut guidance. We know that tariffs are going to cause their cost of goods to go up. So how much of that do they pass on to consumers? And then a lot of their sales is consumer discretionary buying, right? So as these prices go up, at what point does the consumer say, you know what, I'm going to pause. I don't need that anymore.
Yeah, I mean, it's a lagging indicator, right? But it's not that long of a lag.
For sure. Yeah, it's things are a lot faster than they used to be.
Yeah, I think for me, I mean, I'm watching kind of what's going to happen here with the policy response in China, right? I mean, I think, let's not forget here, right? The tariffs, they go both ways.
For sure.
Even though it'd be nice if everybody was at zero, that's not not what's happening. No. So, I mean, if Beijing, retaliates, this thing's going to continue to escalate. So that's kind of what I got my eyes on. But
and we'll probably see a little bit of that back and forth for sure. So
yeah. Well, guys, thanks. I know we went a little long today here, but just kind of wanted to give our clients kind of a Q1 recap and a kind of a macroeconomic view on tariffs and policy changes and things like that. So that's a wrap for today's episode of Old Time Investor, guys. And obviously big thanks to you, Scotty, and big thanks to you, Adam. Always a pleasure breaking it down with you guys both.
Thanks.
Always a good time, buddy.
Yeah, even when the market's
up, right? And had a great time. I would say everyone forget your brokerage account logins for the time being.
Yeah, turn off the news for a little while too, right?
I like it. I like it.
All right, guys. Yep. Thanks for joining us. And until next time, we'll catch you on the Bold Time Investor. Later.
All right, guys. Thank you.
The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Securities and advisory services offered through LPL Financial, a registered investment advisor. Member FINRA SIPC.